In the last video, we covered what determines structured note returns: the underlying asset, the barrier level, the tenure, the issuer, all of it. And I think after 7 videos, a very practical question probably comes to mind. These notes look interesting, but is it actually right for me? That is the most important question in this entire series. Because a structured note is not inherently good or bad, it is a tool. And just like any tool, it works when it fits the situation, and it creates real problems when it does not. In this video, we'll look at both sides: who structured notes may be suitable for and who should think carefully before going anywhere near them. This is the video I wish more investors would watch before they put any money in. Now, most investors who first look at a structured note start with the same question: what is the coupon? What return am I getting? And that is a completely natural place to start. Returns matters, of course they do. But here is the problem. A 14% coupon means nothing if the product does not fit your situation. For argument's sake, imagine you are looking at a note with 14% conditional coupon, a 3-year tenure and a 60% barrier. On paper, it looks attractive, but you may need that capital in 8 months. You are not fully clear on what the 60% barrier actually means. And you have not assessed the issuer properly. The coupon is still 14%, but is this the right product for you? The answer is no. Not because the note is bad, because it does not fit. That is the principle behind this entire video. Suitability comes before return. The question is not only what this note can deliver, the real question is whether this note belongs in your financial life. So let us look at who structured notes may suit. I want to be precise about the language here. I am saying may, not will, not should. No product is a guaranteed fit for anyone. These are the conditions where the match tends to work. The most important condition is this: the investor has capital they do not need in the near term. Not their savings, not their emergency fund, not money earmarked for something in the next 12 months. Surplus capital, money that can be committed for 2, 3 or 4 years without creating pressure anywhere else in their financial life. Then there's a question of what the investor actually wants. Some investors want open-ended upside. They want to ride the market wherever it goes. Structured notes are probably not the right fit for them. But some investors want something different. They want to know before they invest what is the best case, what is the worst case, and what needs to happen for them to get paid. That investor tends to be well suited to structured notes because that is exactly what the structure provides. Income is another condition. Regular cash flows, quarterly or semi-annual, without taking full equity risk or setting up for the low return on a fixed deposit. Structured notes can be engineered to deliver a defined coupon at regular intervals with a level of capital protection underneath. And then there's a profile I see very often here in the Gulf: the investor who is heavily concentrated in one asset class. In this region, that is often real estate. There is nothing wrong with that, but concentration creates its own risk. Adding an instrument that behaves differently, one that is not tied to property prices, that delivers income on a defined schedule, that changes the overall shape of the portfolio. In Geneva, the clients who use structure notes most effectively always had one thing in common. They had a stable financial base already, and structure notes were one deliberate instrument within that base, chosen for a specific purpose with a specific outcome in mind. That is the profile that tends to work. And that commitment to the full term is not a minor detail. Structured notes are not like a fixed deposit that you can break with 30 days notice. They are not like a mutual fund where you can redeem tomorrow. They are instruments with a defined term, and they are designed to deliver their outcome at maturity, not before. And in most cases, you can exit a structured note before maturity. The issuing bank will buy the note back, but they will buy it back at the market price on that day, not at the price you paid. If markets have moved against you, that price can be below what you originally invested. The structure was designed to protect your capital at maturity. early exit and the protection may not apply. Before investing in any structure note, ask yourself one question. Can you genuinely commit this capital for the full term? 2 years, 3 years, 5 years, whatever the tenure is. If the answer is yes, that is a solid starting point. If there is any real doubt, if there is any chance you may need this money before maturity, then this portion of capital should not be in a structure note. The structure rewards patience, it punishes early exit. Be clear about which situation you are in before you put any money in. Now, there is something else that determines whether structured notes are right for you, and it has got nothing to do with your net worth. It is your understanding of what you are buying. You do not need to be a derivative specialist. You do not need to understand how options are mathematically priced, but you need to understand the terms of the note in front of you. There are 3 questions I would ask any investor before they commit capital to a structured note. As a genuine test of understanding, can you explain in your own words what needs to happen to this note to pay? Not the headline returns, the actual conditions. What triggers the coupon? What happens if the underlying falls 20% before the first observation date? Can you explain what happens if the barrier is breached? We covered this in video 3, but can you explain it without looking at the term sheet? And can you assess the issuer? We covered counterparty risk in video 4. Do you know how to read a credit range? Do you have the basic sense of the bank's financial strength, not just the name, and whether that institution is in solid position? Because if the issuing bank runs into serious difficulty, the performance of the underlying becomes irrelevant. If you can answer all 3 clearly, you are in a position to invest. If you cannot, you're not ready. The coupon may look attractive, the structure may look solid, but investing without understanding is not investing, it is guessing. We have looked at who the structure notes may suit. Let us be equally direct about who they do not suit. If there is any real chance you need that money before the note matures, you should not be in this product. Not because exiting is impossible, because exiting early may cost you. Then there is an investor who cannot explain what they are buying, not approximately. Clearly, if you cannot describe the condition for the coupon, the barrier level, and what happens at maturity, you are not ready. Someone putting a high coupon in front of you and asking you to sign is not education, it is a transaction. There is a difference. There is also the investor who cannot sit through temporary market falls. During the life of a structure note, the underlying may fall significantly. That is normal. The structure is designed to handle that up to a point. But if a 20% drop in the underlying causes you to want out immediately, you would likely exit at the worst possible time. Then there is investor who has not assessed the issuer at all. Not someone unfamiliar with every metric, but someone who has not asked a single question about the bank behind the note. Who is issuing this? What is their credit rating? Has that rating been moving in the right direction? If you cannot answer any of those, you are carrying a risk you have not priced. If this money has another job to do, business expenses, purchase coming up, family commitments, it should not be in a structured note. No coupon justifies putting the wrong capital into this product. Alongside the wrong investor profile, there are wrong reasons to invest. The coupon. When an investor looks at a structure note and the only thing they register is the headline number, 14%, 16%, 22%. That is a problem. A high coupon is the result of a specific conditions, specific barriers, specific risk. If the coupon is the reason for buying, the right questions have not been asked. Then there is the name, JP Morgan, Goldman Sachs, Citibank. These are all strong institutions, but a well-known name is not due diligence. We covered in video 4 what happened with Credit Suisse, a name many investors considered untouchable. Then there's a phase, capital protected. Investors hear it and stop asking questions. We covered in video 3 that capital protection can be conditional or unconditional. Those two things are not the same. If someone uses the phrase without explaining which one applies, that is not a green light. And then there is the investor using structure notes to recover losses. Someone has lost money in equities, in real estate, and a 14% coupon looks like the way back. That is not a strategy, that is pressure, and pressure produces poor investment decisions. Everything we have covered in this video, the right profile, the wrong reasons, the conditions, comes back to one question: does this product fit your situation? Let me put you in concrete terms. For argument's sake, take two investors. Same note, same terms, same issuer. The first investor has capital set aside for medium-term investments. They can hold for 3 years without pressure. They understand the barrier, the coupon condition, and the issuer's credit profile. They want defined income. This note may suit them. The second investor may need the capital in 6 months. They have not read the term sheet. They are drawn to the 14% coupon and have not asked what needs to happen if it does not suit them. The note has not changed. The investor has. Structure notes are not magic. They are not dangerous by default. The question is never whether a note is good. The question is whether it is good for you, given your liquidity, your time horizon, your understanding of what you are buying, and your ability to hold to maturity. If those conditions are met, structure notes can be one of the most precise tools in your portfolio. If they are not, no coupon is worth it. In the next video, we cover the complete risk profile of structure notes. Every risk associated with this product laid out clearly. If you have questions, feel free to reach out. I'll see you in the next one.